Well, I actually think that we see signs that inflation is calming, and that is really the key that has to happen for the market to have some kind of sustained rally. And I'm actually I get positively impressed with the composure of the bond market. And for those that want to get really crabby and think that we're going back to the 1970s, you know, the 10-year is below 4% at this point. And back in the 70s, the bond market was saying, hey, we need to be vigilantes here, and you really need to worry about inflation. And I think they're saying we don't believe the Fed. We don't believe the Fed's going to jack these things up as high as you see in the headlines. And actually, yields have held in very well, suggesting the bond market thinks inflation's going to calm and the Fed's not going to have to jam it. So what I see in the bond market overall, exit a day like today, is pretty encouraging. No,
I take your point, but Steve, I'm curious what you think as well. Why the last couple of weeks have we suddenly started to see bond yields creep back up again?
Europe.
Rick says it's Europe. Steve, what do you think?
I want to hear what Rick has to say about this. But I want to say Lagarde went max hawkish. That's competition from European bonds. Japan widened the band on its 10-year yield curve control. And so there's competition from overseas. And I think you make a very interesting point. This is happening just as you get the sense that inflation is cooling, which tells you essentially, Kelly, that it's the bond yield is not strictly tied to the inflation outlook. In some ways, it's been negatively correlated in the sense that the higher inflation went, the more people thought the Fed was going to make a mistake, and you'd get this inversion out there. But right now, I think it's a resettling or a search for a new equilibrium between global bonds, which had previously been much more tied at the hip before the pandemic, and now I think they're getting recorrelated, if that's a word.
Yeah, what would you add to that, Rick? And are we going to, how much do we interpret any kind of December moves as too much? But when people are saying, it's just a day or two, but Steve's right. I mean, things have changed globally. Look at Europe. You look at Japan. I don't know. What about here?
Oh, yes, and things had to change globally. Listen, Japan has gone decades with ultra-low interest rates, managed markets, and many people think they've gotten away with it, but they haven't. If you've owned their stock market since 1989 when it peaked, you're hurting. You could be long at just under 40,000. This is still well below 30,000. So there are issues here. And I think especially in the last week of the year, the shorts aren't going to defend the U.S. markets. I think we're going to continue buyers aren't coming in. The shorts are going to continue to be aggressive in the market. Why? I think because of Europe, because of Japan. Steve nailed it. Those two issues change much of the dynamic. Remember, the more mopping up, the more QT that ultimately comes out of Lagarde, even though she has a multi-speed cure for what ails Europe, the more fungible quantitative tightening will be, and it will affect all economies. Yeah. I do think the U.S. is going to see buying coming in, but I think in this thin market for the rest of the year, I wouldn't at all be surprised to test 4% in a 10-year and 4.5% in a 2-year.
Yeah, wow. All right, Jeff, let me bring it back to you. How did you guys perform in 2022, and where are you looking for 2023?
Well, we performed well because we had a high quality and a more defensive positioning. And we really warned clients and investors to brace for a 20% type of correction going in. And we used the word correction because we didn't think it would last virtually all year, but we knew it would last, for a bit. And, our thought was if the last 3 years going into 2022, you were a 60-40 investor and the 26% annualized returns took you to 70% or more, you know what? Don't be greedy. Cut back to normal. Rebalance. Go back to 60% and kind of stay there. And, oh, by the way, don't buy on the dips. And we knew all these transitions were happening.
But did you rebalance into bonds? Because that wouldn't have worked so well.
Well, I tell you what. It does work. If you build adequate liquidity and you have cash and you have an individual bond portfolio that's laddered out that sounds so boringly simple.
Right.
It does. But it works. It's an outstanding, elegant way to manage risk in an environment like this. So we didn't lose money in bonds. Our clients didn't have to sell bonds like you do in a bond fund. You simply wait to collect your principal at the end and you earn your 2, 3, 4% that's advertised.